Hey guys, so in this video, I'll be reading a chapter from trades about to happen, which is on tape reading part 2. Okay, so let's get started. Okay, so another method I used for displaying the waves and wave volume simply involved the use of a close only line chart with a volume histogram. It too served me well. One missing ingredient, however, was time. Whenever the duration of a wave was unusually large, I noted it on chart. Eventually, I found someone to write a program for the wave chart. No longer were the waves plotted equidistantially. The space between waves reflected the duration of a wave. Okay, and the width of the volume bars was also a function of time. From that point, so that's quite important. Okay, now from that point I had all three elements necessary for tape reading: length, volume, and duration of waves. Okay, now in the discussion of bonds on June 15 and 19 2001, I made numerous references to these three elements when appropriate. The tabular listing of the data made this possible, but with the new chart it became readily apparent at a glance. It allowed me to experiment with wave charts made from any time period. Suddenly I saw price waves that lasted many days, and the wave volume told a better story than on the hourly or daily charts. The reason is simple. Price movement does not unfold in bundles of equal time periods. It unfolds in waves. Wyckoff early tape readers Wyckoff and early tape readers clearly understood this fact and therefore studied the alternating buying and selling waves gleaned from the stock ticker. Dissecting price movement into time periods does not impede one's view of the trend, but volumes are divided into equal chunks of time does interfere with one's ability to discern the true force of the buying and the selling. In a sense, the message of the volume is lost in time. To illustrate the point, figure 10.1 of the December 2012 Euro contract is presented here. First though, let me explain the chart. For intraday currency or forex trading, I prefer a sensitive tick bar chart. I also took a time-based charts, but the construction of the tick bar is not limited by a set amount of time. Thus, under volatile trading conditions, one 250 tick bar may span a few seconds, and at other times it may last 20 minutes or more. Larger tick bar charts are also useful for visualizing the broader price structure. For example, I sometimes look at the 5000 tick bar for currencies on the Standard and Poor's S&P 9000 tick bar. Figure 10.1 Figure 10.1 shows a 3-peak wave constructed from 250 tick bar closes on September 18, 2012. The total contract volume for each tick bar is also included. Starting from the left side of the chart, we first notice the large up wave with 5400 volume. This is the heaviest up volume in after 4 hours. The shortening of the upward thrust on the top move stands out clearly here. It says the trend is tiring. Supply appears on the first down wave where the 4100 volume is the largest to date. Okay, here. Okay. Compare this bearish change in behavior to wave 6 in figure 9.12. It's in the previous chapter. So where demand first appeared on the subsequent upwave, the 1000 volume signaled weak demand and offered an excellent entry point for selling short. For the most part, the tick bar volume looks like the three line on the horizon. You can find little differentiation between the volumes, whereas the cumulative wave volume shows the peaks and troughs of trading activity. Nowhere is this more important than on the 1100 1000 and 100 contract pullback where the tick bar volume shows little change. Similarly, the 4100 contract decline from the high does not stand out as heavy volume on the tick bar histogram. Within the decline from the high, the down waves span 13, 19, 19 and 4 pips respectively. Okay, it's like 13, 13, 19, 19, 4 pips around. Okay, respectively the individual times per wave are 10, 16, 4 and 2 minutes. Add to this picture their diminished wave volume and the turnaround from the 9:30 a.m. EDT low is obvious. One final observation: the next to last down wave covered as much ground, 19 pips, as its preceding wave, yet it lasted only 4 minutes. The speed of this down wave reflects climactic action as the trapped longs are stumbling over one another to sell out. It tells anyone who is short to start taking profits and or jamming their buy stops to within a few ticks of the last print. Would be buyers should move to the edge of their seat in anticipation of a short covering rally. 22 minutes after the final low, the euro traded at 1.3077. Figure 10.2 shows a 3-minute chart of June 2011 Australian dollar. I have removed the individual 5-minute bars. The minimum wave size or reversal is 3 pips. The minutes per wave are plotted at the wave turning points. Now look at the rise from 115. We see the 3 up waves span 12, 36 and 6 minutes. Okay, 12, 36 and 6 minutes. 3 up wave, 1, 2, 3. Respectively, their lengths are 10, 21 and 5 pips. 10, 21 and 5 pips with volumes of 1896, 1896, 20,000, 2038 and 1305 contracts. The diminished line length and volume on the waves reveals the market's weakening condition. Okay. They tell the tape reader to take profits on long positions. Wyckoff would advocate taking profits and immediately going short in such a position. The volume histogram is cumulative. Okay, the 27-minute down wave consists of 9 3-minute time periods and the total volume increases evenly until the 9th period of this wave where it bulges. This format helps one see the spurts of volume that often occur at tops and bottoms of waves. For another example, look at the volume jump in the last period of the 6-minute up wave to the high. Okay, this. Within the decline from the high, all the rallies are small and short-lived. Within the decline from the high, all the rallies are small and short-lived. They can be used. Okay. They can be used to add a short position or to get abroad if one or to get aboard if one failed to recognize the top. The same can be said about the small low volume corrections during the preceding rally, right? Okay. Now currency futures and corresponding future forex markets offer a unique feature as the 3-pip wave size can be used on each one. This allows the trader to move from one to the other in search of the best setup without having to reconfigure the wave settings. Okay. Now, when trading, I often superimpose the wave chart on top of the price bars. This allows the trend lines, channels, and support or resistance lines to be drawn from the precise highs and lows. Lines drawn on a chart like the Australian dollar where the price bars are hidden still work. Well, I always like to filter as much data as possible. This way, much of the intraday distraction and ambiguity is removed. because intraday price bars can give mixed messages. Their removal makes it easier to hold a position that might otherwise be closed out prematurely. An affliction suffered by many traders. Okay, now figure 10.3 shows all the important lines on the May 2011. Okay, NY copper wave chart. It is constructed from 5-minute closes and uses a 25 0.0025 reversal. The minimum tick is in top copper is 5 into 10 to the minus 4, valued at $12.50. Thus, a 1 cent move from 4.38 to 4.39 equals $250. The chart provides a tour de force of wave analysis. Wave time and volume are plotted at the turning points. Wave time, okay, wave time and volume are plotted at the turning points. Okay. Now, starting from the 8:40 a.m. Okay, starting from the 8:40 a.m. EST low, copper rallies over 2.5 cents in 35 minutes. Okay, 8:45 a.m. Here it rallies from to 2.5 cents. Okay, in 35 minutes. Here 35 minutes. Okay. Next we see 7 waves of lateral movement in which the volume diminishes. Okay, notice. Next we see 7 waves of lateral movement in which the volume diminishes. The 35, 17, these, it is like diminishing volume. Okay, now notice the 5th wave where the market slips 1.4 cents on rounded volume of 300 contracts. Okay. The next down wave spans 0.60 cents on volume of 200 contracts here. 300, 200 contracts. The two waves span 5 minutes and 10 minutes respectively. Many times a 10-minute wave will have larger volume than a 5-minute wave when they occur consecutively. The small volume and the size of the latter tell us make copper is on the springboard an ideal place to go long. The following up wave runs 2.65 cents in 55 minutes and speaks of strong demand. Okay, 55 minutes. No supply appears on the 10-minute reaction. No supply, yep. 7 contracts, 55 minutes, 7 minutes, 10 minutes, right? So, right. So no supply, okay, no supply appears on the 10-minute reaction. The next upwave, no supply appears on the 10-minute reaction. The next upwave gains another 1.25 cents in only 25 minutes. Okay, but volume falls sharply. It is the first sign of weakening demand. From this point, the action of the sellers begin to dominate the chart. Okay, here. Now, after two small waves, down and up, an overtly bearish change in behavior occurs. Copper has a shallow decline, but it lasts 30 minutes, the most downtime since the 8:40 a.m. low. It is also the largest sell-off since copper lifted off the springboard. Now the market has a fast rally above the previous high. In the third 5-minute bar of this rally, the wave volume triples and prices close well off the high. A potential upthrust, the next down wave extends slightly below the low of the previous sell-off. Okay, it is larger and spans another 30 minutes. The change in trend has become obvious. Prices now creep a mere 0.3%, 30 cents higher over the next 45, 0.30 cents higher over the next 45 minutes underscoring the total lack of demand. Wyckoff described this as a springboard position prior to markdown. Okay, springboard meaning like the slope is like less than 45. Okay, less than 45 degrees. When we like draw trend lines, it is sloped at 45-degree angle. Okay, and you can see like drawing these trend lines is the best description of any overbought or oversold condition. Mathematical formula like RSI, anything you like see, this is nothing like any of the indicators, right? It's just the pure geometry and it works like a great. Okay, I mean it works like most of the time, like even more and more time than the RSI. Okay, because trend line are also fractal, but you can draw it on like any time frame. So yeah, so the low angle of advance, see the low angle of advance on this last up wave shows how much difficulty copper had on this rally. Such information was not as apparent on the tape reading charts. Okay, so yeah, we gotta look for the angle of advance as well. Okay, figure 10.4 presents a 0.50 point wave atop a 5-minute chart of the June 2011 S&P contract on May 6, 2011. It shows the kind of trading turn that one sees every day for the S&P. Wave volumes are noted in thousands of contracts. Here we see a resistance line at 1349.50. Okay, here which is penetrated a few hours later. The volume reaches the highest level for any previous up wave. Okay, 141 contracts, 141,000 contracts, and the S&P appears at the beginning of a larger rally. Okay, anyone who trades the S&P regularly knows to be on guard for a whipsaw whenever a new high or low is made. It's the nature of the beast. The reaction of this high draws out the heaviest volume in the last 5 down waves, but it's not covert. Its modest size makes it seem less threatening, but the next upwave speaks to us. No ease of upward movement, no demand, potential upthrust on previous upwave, and the risk to the previous high is only 0.75 points or $37.50 per contract. Okay, so you can't ask for anything better. A short can be entered as soon as the wave shows a 0.50, 50-point reversal. 25 minutes later the S&P traded 7.25 points lower. By 2:40 p.m. it had fallen another 11 points. Okay, it had fallen another 11 points. All this form a subtle change in behavior. Okay, it's the volume that makes wave charts valuable, as mentioned earlier. Okay, it's the volume that makes wave charts valuable. All right, now as mentioned earlier, time-based volume often fails to reveal the true force of buying and selling. Nowhere is this more evident than with daily volume, where the readings look about the same. It is particularly true of daily stock volume. The wave's minimum size of 10 cents on the US Steel daily chart, figure 10.5, tell a typical story. I have included the daily volume so it can be compared with the clarity of the wave volume. The sell-off in October 2010 consists of two large down waves, okay, of 56 and 64 million. 56 and 64 million shares each. On the day before the second wave ended, the actual volume rose to 19 million. Okay, so we are talking about here, right here. We are talking about here, right here, yeah. So now, um, the largest on the chart, okay, on the day before the second wave ended. On the day before the second day ended, okay, the actual volume rose to 19 million, the largest on the chart, following the low on October 27th. Okay, okay, yeah, it was here. Let me grab my pen. All right, let me grab my pen. Um, Setting here. Um, Connecting. I just wanna first monitor, second monitor. All right. Okay, so we're all set here. So we are looking at here. All right, we are looking at here. So um, so see the heaviest up volume since early March, right? So 90 million was the heaviest volume since early March. Now the actual volume for the same period does not stand out and looks very much like the readings in early October. While the wave volume looked climactic at the October low, there was no low volume pullback to enter a long position. But the wide range up bar of the low signaled the presence of demand. Okay, the high volume lift off indicated that the force of the buying had overcome supply, and the greatly diminished wave volumes on the three down waves within the November correction reflected a lack of supply, especially the 19 million down wave. Over the next 17 sessions, there are two up waves spanning 9 and 7 days. Okay, 9 and 7 days, and um, respectively, right? Between them is a one-day correction. Strong demand enters on the two up waves after a shallow correction in December. The stock makes another new high on the first trading day of January 2011. Okay. Notice the low wave volume that indicates no demand. This high marked the beginning of a top formation that lasted for several months prior to a large sell-off. See how the waves themselves act almost like moving averages. In the markup stage, prices may rise for 10 or more days without a correction on a closing basis. From the low of the down arrow, the stock rallied for 17 days. Okay, the one correction lasted only a day. This is a perfect example of the way moving in an uninterrupted manner, like a moving average. The one little correction was really a buying opportunity for a momentum trader. Figure 10.6 of Boeing 10-cent website typifies the most common trade one frequently encounters. Okay, when we examine the bar chart alone, we see the vertical price rise at the end of April 2011. Okay, yeah, this behavior certainly had all the earmarks of a buying climax, but the actual volume failed to signal the supply on the first down wave. Okay, the wave volume gave a much clearer picture of supply on the first down wave. Okay, here the cumulative volume revealed the greatest selling pressure since mid-December 2010. And it is followed by a low volume secondary test of the high. The bearish wave volume made this trade effortless. Okay, it was aided later by the pristine line drawn across the low of the first down wave. Here, um, after the line was penetrated, two minor rallies stopped against it. Okay, on the last wave at the bottom of the down channel, a supply dried up and the stock had a brief rally here. So we went from here to here, and then we had a brief rally. It was unable to move above the first low made after the high in August, going from support around the 56 level. Okay, the 56 level. Okay, now as we had seen, Wyckoff's tape reading chart involved surveying every price change, something impractical given today's volatility. To avoid this problem, I use a wave chart based on the closing price of any time period from 1 minute to 1 day. Yet this from 1 minute to 1 day, yet this is inconsistent because I'm still relying on time-based data. To avoid this inconsistency, I often use tick-based charts. A tick bar chart consists of individual price bars based on a predetermined predetermined number of ticks or price changes. For example, every 3000 tick bar has the same number of price changes under normal trading conditions. A 3000 tick bar chart of the S&P spans approximately 5 minutes. When trading activity increases after the release of an economic report, however, 3 bars of 3000 tick bars each may occur within 5 minutes. Thus, a tick bar chart reflects trading activity. The volume plotted below the individual tick bars shows the actual numbers of shares or contracts traded. Okay, but the duration of the tick bars differs. One may span 5 minutes. Okay, one may span 4 minutes, and the next one lasts in 18 minutes. It all depends on the speed of trading. Wyckoff saw the importance of activity. Okay, he had no way to make tick bar charts. Instead, he used a cruder method for judging the activity of the stock market in general. He measured the distance the ticker tape traveled in inches per wave. Speaking of pristine behavior, the price volume action on the 5000 tick bar chart of December 2012 gold figure 10.7 here takes the cake. Clues abound about the coming down wave on September 25th, 2012, a day when the S&P and many stocks were also hit by heavy selling, discussed in Chapter 11. The story starts with the shortening of the upward thrust on the final upwave to the high where the volume 2.0K shrinks dramatically. More overt clues are the next two down waves on 5.9K and 5.1K. Okay, 5.1K and 5.6.9K. Okay, 5.9K and 5.1K respectively. On the secondary test of the top, the wave volume increases to 4.1. Okay, here to here, we went from here to here, and then the volume raised from 51 to 41. 4.1K. Despite this large effort, gold refuses to make a new high, and we now know the market has encountered supply. On the ensuing sell-off, the downwave volume 6.9K is the largest on the chart today. A relatively flat three-wave pattern unfolds from this low. Okay. The message of the third wave is overly bearish. It consists of 7.2K volume in spans 54 minutes. Okay, and has a very low angle of ascent. See here, like when we're looking for like 45 degree, it should be 45-degree angle for like angle of ascent. Okay, and this is like ideal angle of ascent which we are calling 45 degree, but that's like a good trending market, or like a good effort, a good effort plus good result. Okay, and when we see this angle of ascent where like less than 45 we see, and the minutes are more, okay, then it has a very low angle of descent. We see that here we have a great deal of time and volume without making any upward progress. Also on figure 10.3, which we looked earlier, the personification of weakness. Okay, always pay close attention when this behavior appears on wave chart. It offers a high probability trade setup. Okay, So let's just mark it up. Okay. Okay, year to year. Okay. I think we gotta look at like one, two, three, four, five, six, around like six uh, waves total, like up wave plus down wave. Okay. All right. Now, similar behavior occurred in 10 and core. Figure 10.8 here. Okay. During January 2012, here we have a 10-cent wave applied to daily prices. Support formed in December 2011. Okay, support formed in December 2011. Here, but the first rally of this low failed to attract enough demand to sustain itself. Okay. Um, the retest was most disconcerting as prices hovered for days just above the low. Okay, here now one down wave during this period of latter movement lasted 5 days. The slow time coupled with the very heavy volume and relatively flat angle of decline could be incorporated as sellers observing all buying. The bullish interpretation says backholding is taking place as the buyers steadily take all offers. Okay, so let's mark it down. Two up waves. Two up waves later, the buyers show their hand as the stock rallies on even heavier volume. On the final down wave, the sellers manage to break down the support line. Okay, but there is no downward follow through here, and prices rally briskly. These nearly flat waves represent compression. Okay, these nearly flat waves, okay, represents compression. Let me write it down. Compression. Okay, so yeah, um, one of the most common trade setups. Okay, let's actually mark it down. Actually, uh, it's quite important. Okay, so one of the most common trade setups involves shortening of the thrust. Okay, traders often confuse shortening of the thrust with springs and up thrust. Okay, so I just want to like highlight it down because Wyckoff methodology involves like you got to describe it, like put a label on certain points in the market where you think that something's gonna happen, right? So like upthrust, we see that like in upthrust market tends to go down. Okay, because it had made its top. All right, it has reached its top, and sometimes it's just overbought condition. All right, so we kind of like it is like, and I have also found out that like um, assigning some labels to what you're thinking on the chart and what do you think is important is very like fundamental to the Wyckoff methodology. Okay, so let's continue. um, the name matters little. All right, shortening of the thrust is diminished progress as measured from high to low or low to low. Okay, so shortening of the thrust can be like either high to high, so we can be like measuring lower highs or higher highs, like we could be measuring lower lows, higher lows, right, which which represent a bullish or bearish sentiment. Okay, so when shortening of the thrust occurs on very low volume or heavy volume, the message becomes more apparent. It requires a minimum of three impulses, okay, which may not always coincide with wavelines. Figure 10.3, figure 10.9 of Cliff's natural resources demonstrates much of this behavior. If I wanted to specialize in a small handful of stocks, CLF would be one of my choices. The 10-cent wave size works well and the stock has plenty of volume and volatility. On October 13, 2011, CLF held its earlier low at 11 a.m. All right, despite the increased volume 159K, this was a minor double bottom and an orderly three wave impulse began. All right, orderly three wave, one, two, three. So like if you consider this as like wave, like how do we like define a wave? We like when we say wave, like this comes to our mind, like sine wave. Okay, all right, okay, like the sine wave, so it starts from the origin. Okay, so this is what sine waves looks like. Okay, so this is wave, and like if you add some component it, so like sine x is here. All right, so we have y equals to sine x, so our function is sine x. Okay, now whatever value we want to put here x, we will we will get the value from to -1 to 1, right? So that's our range. All right, and then x is our domain, and we can like search any number in this domain, any number whatever we want. All right, the result will be -1 to 1. But in the case of stock market or stock market science, what happens is that this, like, we have some condition to it. So if I add something to it, right, sine x plus something, say 5, so we are adding 5 to it, and 5 means what does 5 mean? So if we like take 5 here, we get 5, y minus 5 is equals to sine x. So if you see, our range is 1 to -1. So if we like get 1 to -1, so y minus 5 would be around -1 to 1, and we can see the range of y would be become like -4 to 6. All right, now the curve is now shifted. Okay, now we have our trading range from like it has also shifted. All right, so it will be -1, -4 to -5, it will be 6 to 4. Now we got bigger waves. Okay, the sine function is same. Now what I'll do right now is, I'll just okay, oh no, it's not -4. That's why I was getting confused. Okay, I'm I'm actually teaching you guys mathematics, so anyway, that's cool. So 6 to 5, right? 6 to 5 is our range, right? So what we gotta do is we can draw it. Okay, so this is our these coordinates. We have 4 and then 6, right? So our curve is now shifted, and no, and we are not getting 0 right now, so it's around like this or something. Okay, so if we put here x will be 0, so when we put 0, what we'll get, y was sine x plus 5, it will get 5. All right, it will get 5 here, so that's where we are crossing now. Now now what we gotta do for market is that, like, as we are adding scalar to it, right, as we are adding scalars to it, and we are increasing our range from like going from 0 to upwards, right, what we are adding is we are adding angle to it. And how we can do it? Okay, how do we do that? How do we add angle to it? So if you like know about like slope formula or slope. The definition of slope is like change in y by change in x, right? That's our definition of slope. Is it okay? Okay, it's actually change in x by change in y. Okay, so when we see change in x-axis, all right, change in x-axis is time, all right, and change in y-axis is price. Okay, and if we like divide price, this time by price, we get our like angle, right? And if it is like around 45, we go up. Okay, if it is around the angle is flat, we go like flat. Okay, so that's what's happening here. And if you draw a curve wave here, you can see this is our wave. Okay, this is our wave, and this wave could be fractal too. Okay, we could draw bigger wave if we smooth the prices, but we are looking at the raw prices adding up to that wave size, all right, wave volume. Okay, so we are constructing a wave basically. So I think that was a pretty good like applying basic fundamental into stock market, the market science. All right, stock market science is where you can like where you can apply any principle. I see like okay, let's not go there because we are looking at the main essence of Wyckoff methodology. So okay, let's construct wave volume. All right. Okay, so so this was a minor double bottom and an orderly three wave impulse began. They are they are identified by drawing horizontal lines above the high points. Okay, here. Now the shortening of the upward thrust stands out clearly on the third wave where, so shortening of the third up thrust like stands out very clearly on the third wave where the volume was 41K, all right, where the volume was 41K here, okay, was substantially lower than the previous up wave. Okay, so this was 107, this one is 41K, which is very less. Okay, very less. Okay, so we have one I think 107K, which is way greater than 41K. All right, so that's what's happening here. And so this is showing us this shortening of the thrust, which means that this from this high, the stock curve corrected this its recent rally. The next impulse consisted of four highs with shortening of the thrust in the final wave where the up volume 36K, all right, 36K here was the lowest since the 11 a.m. Okay, now 11 a.m. low. Okay, now from this high the market traced a two wave pattern in which the second wave experienced a spring rather than shortening of the thrust. Okay, here this is a spring. Okay, um, the final rally subdivided into two up waves, but the price bars show three. Okay, I always measure shortening of the thrust from the price bars rather than the wave turning points. Okay, so this is quite important. All right, I always measure shortening of the thrust from the price bars. All right, rather than the wave turning points. Okay, so what does it mean is that it could mean two things actually, because shortening of the thrust could be measured by number of individual bars which is going on. So like uh, earlier we have seen like and it took 50 minutes to form this wave, and the result was less, right? So that could be one point for identifying the shortening of the thrust. Okay, and another point would be to see the price change, like how much did we travel from previous down wave to next up wave, right? So from here to here, how much did we travel? So if we like draw a line here, if see we travel from here to here. So let me just draw, like, this is not a good line, by the way. We gotta see this line. So see, from here to here we went there, then here, then it was, see this, it was decreasing, all right. It was decreasing. Okay, then we go here, then we went down. See, this is what's known as sorting of the thrust. Okay, so we can do it like both way. All right. Now if you see from here to here, the number of bars were more here, but one place where this might fail is like where you have this steep like angle of ascent very less, where there you see like lot of small volume. But the point here is that like when you have tick bars, right, tick charts, it doesn't really matter, right, if it is small or uh, a big candle basically, right, because it needs to travel only this distance, right, and it could take it like 1 hour 2 hour anytime. But if the distance surpass this level or this level, then the market will go down or up. This is where I think Renko chart works really great. Okay, because it like reduces a lot of noise here. So that really could work in a great advantage of like identifying the market turning points. All right. So since sorting of the thrust stands out as the most common trade setup on the intraday charts, I have formulated a few guidelines. Do not consider them to be ironclad rules. Okay, so we can like include our own rules basically, but it should have context. All right. Now after 3 or 4 successive waves or impulses up or down, look for a shortening of the thrust in the final wave. The wave usually makes a little progress and the volume declines, indicating tired demand and or loss of momentum. Sometimes the wave volume is heavy, but the shortening of the thrust indicates the large effort produced little reward. The so-called three-push method ties the same behavior to divergences on an oscillator but makes no mention of thrust shortening. Okay. Now, second guidelines is when there are more than 4 successive waves and shortening of the thrust persists, the trend may be too strong to trade against. Okay, when there are only 2 waves with small progress in the second wave, consider a spring or upthrust. Ideally the volume should be low, however small progress with heavy volume is acceptable. Okay, the shortening of the thrust is determined mostly by the price bars, highs and lows, rather than by waves turning points. But the wave volume tells the story about the strength or weakness of demand and supply. Okay, let's look at this one again. The shortening of the thrust is determined mostly by the price bars, highs and lows, rather than by the waves turning points. But the wave volume tells the story about the strength or weakness of demand and supply. Okay, so this is like a good rule of thumbs to follow, or not sort of rule of thumbs, but yeah, it is quite good rules. So another word about them, about item I one above is, okay, above, another word about item one above is required. When thrust shortening appears, always consider the larger picture. This rarely involves the weekly or monthly charts, but a check of the market's position on the daily never hurts. For example, price rallies above the top of a 3-month trading range and reverses down. The potential upthrust becomes the overriding consideration. After a few small down waves, the downward thrust may shorten and suggest a long trade. Any long trade taken in this kind of situation is best avoided or quickly closed out if the response weakens. when prices are moving above or below turning points established during the previous up or down waves and breaking trend lines. Be highly selective trading against the trend. Determining when to act with the shortening of the thrust setup is an art, not an automatic trading advice. Okay, so many wave setups are often centered on the drawing in figure 1.1 regarding where to find trades. Setups combined with springs, upthrusts, absorption, and tests of breakouts and breakdowns work extremely well. When a spring upthrust occurs, look for a bullish or bearish change in behavior. If the selling buying pressure diminishes on the next pullback, take the trade and always protect with a close stop below or above the extremity. The same works with a high volume breakout or breakdown. When these occur on heavy volume, watch the character of the pullback. Okay, low volume at this point indicates a successful test of the breakout. Okay, or breakdown, and the trend should resume. Stop protection goes immediately below above stop protection goes immediately below or above the pullback pivot, the day trader will be astounded by the number of these types trades that show themselves in every session. Two basic requirements: patience to wait for the setups to appear and operating without any bias. Don't tell the market what it will do, it will tell you what it will do. That was quite funny, man, literally. Okay. So immediately below, okay, so this is right. Stop protection goes immediately below above the pullback pivot. The day trader will be astounded by the number of these types trades that show themselves in every session. Two basic requirements: patience to wait for the setups to appear and operating without any bias. Don't tell the market what it will do. It'll tell you what it will tell you, right? Let it tell you what it will do. Okay? Be patient. All right. I mentioned specializing in one particular stock or market for the purpose of intraday trading. To observe the minute, I often use a 100 tick bar chart. This helps one to see many different setups during a trading session. Figure 10.10 shows um, a 100 tick bar of Newmont mining on September 26, 2012, constructed from 10 cent impulses. The heavy volume in the first up waves. Okay, the heavy volume in the first up wave. See this heavy volume, large volume here. Holy shit. Okay, so um, so the heavy volume in the first up waves set the tone for the day as they reflected aggressive buying. We see shortening of the upward thrust on the first three impulses. Okay, 1 2 3. Okay, the sharp drop in the volume on the third impulse warns that a down move will occur. It subdivides into three impulse waves with shortening of the thrust and diminished volume in the third wave down. Okay, as prices turn up from this low, longs should be established and stops placed under the low of the third wave. A big rush of buying hurls the stock above the early morning high. A tiny 4-minute pullback occurs before the start of the next up wave. During the markup, we see three impulse waves, and again the upward thrust shortens. This time the volume remains large, but the shortening of the thrust warns that NEM is meeting supply. The first down wave from this high is a bearish change in behavior. Okay, here we have the largest down volume since the 11 a.m. low, and the down wave is the largest since prices broke out above the morning high. Together they indicate the day's rally has ended. Okay, So normally when I follow a 100 tick bar chart, I scrunch the price movement as tightly as possible so the individual bars are indistinguishable. I'm interested only in the form of the behavior and the structure provided by the lines. Together, they tell a very readable story. Figure 10.11 presents such a chart of the June 2012 S&P 500 with a 0.75 point wave. It really needs little explanation. The most important behavior relates to the low volume of thrust at the high and the shortening of the downward thrust within the sell-off. Okay, so we are looking at around here and here. Okay, so the stopping volume in the down wave to 1339 here indicated the end was near. On the decline to the final low, the thrust shortens and the down wave volume diminishes. Okay. Notice the very high volume on the up wave of the low. Okay. Here. It marked the beginning of a rally to 1356. Okay. Over the next hour. Okay, around here up to here, so it rallied up to 1356 for the next hour. Some might say this is trading on head of a pin, but I think it provides a great edge for the intraday trader. Wyckoff would have loved it. Yeah, really. Okay, so one of my favorite chart constructions involves using two wave lines of different sizes. Figure 10.12 is a 250 tick bar chart of the Euro USD with a 7 pip wave and a 3 pip wave. Tick volume is used on forex charts. Okay, tick volume is used on forex charts. Therefore, each tick bar has total volume of 250 ticks. With the wave chart, we have a cumulative total from the 2251 low, seven pip waves appear. The smaller three here, this is 7 pip wave. So the smaller three pip wave lines twists and turns along the larger wave. Okay, here, then we go on larger wave. There are instances where There are instances where the two waves fit together, as on the 2000 volume decline to the 2251 low. The smaller wave provides subtle clues about market direction, thus helping traders establish a lower risk trade. On the first three pip up wave of the 2251 low, the volume exceeds all of the previous up volumes since noon on the previous day. No supply appears on the next pullback. I would view this as a bullish change in behavior and enter a long position with a sell stop below the low. The uptrend resumes in an orderly fashion until supply appears on the 1500 down wave and demand 1300 wave volume shrinks as the thrust shortens on the final up wave. At this point, the message is take profit. Okay, here. Okay, on September 5th, 2012, I mentioned the S&P 1000 tick bar chart with a 0.50 point, 0.5 point, and 1.25 point wave plotted together between the high and the low. 1.25 point waves appeared within the 3-hour decline. Arrows are placed on the um, arrows are placed on the 50 point waves and volumes, 0.50 point waves and volumes where supply or weak demand indicated prices would more move lower. I'm sure you can understand how the sellers gain control and pushed prices lower throughout the rest of the session. When watching the market, I find trades rather than seek them. Jet Swagger, in his book New Market Wizards, included an interview with a trader named Mr. Anonymous. This trader had made large amounts of money for his clients, but he felt They would not like his trading philosophy as expressed in the interview. He therefore had the interview reduced to 2 pages and refused to reveal his identity. At the end of his remarks, he made the following statements: when you are striving, struggling, forcing a trade, you are out of sync, out of harmony. The best trade requires no effort. I totally agree. This is what Wyckoff meant when he described the tape reader as an automation. Finally, the sentiment expressed in this Tibetan people, in this Tibetan percept speaks volumes about the tape reader's mindset. No thought, no reflection, no analysis, no cultivation, no intention. Let it settle itself. David Weiss. Sorry to David Weiss. So, guys, that's it for chapter number 10, part 2. I have covered the tape reading, and yeah, let me know in the comment which chapter you guys wanna or which book you guys would like me to read next, because like as I'm starting out, like I do know how to explain this. I'm just building on the story, right? See, like Wyckoff and all these great legendary traders says that you gotta be able to build a story out of the chart you're reading, all right, the tape you're reading. So that's the that's my purpose and like goal on this one, on this channel, so that see, the point is like if you don't know about David Weiss, he had like worked on this, on his hypothesis, on his thesis for about 42 years, right? That's like huge time, all right. And at this moment, like, if he has like written book, and it has taken him like 40 years to write it, or basically construct the ideas which popped up in book, and which which he has described in his book. It's amazing, man. All right, so just you guys just let me know what you guys want to let me read, and what to cover, and I'll be happy to read it for you guys. So thank you, and uh, see you on the next video. Thank you.